Silver is currently making the kind of historic moves that most analysts, myself included, thought were mathematically impossible just 6 months ago. We aren't just looking at a price spike. We are witnessing a fundamental decoupling in the precious metals complex. The old rules? They've been tossed out the window. Now the question on everyone's mind is simple. Is silver about to moon into triple digits, or are we standing on the edge of a vertical cliff? Today, I'm breaking down the Silver Thesis into 3 fast, data-driven steps, including a look at how the escalating tensions between the U.S. and Iran are flipping the script on safe haven assets in ways no one predicted. To understand where we're going, we have to look at the sheer insanity of the last 2 quarters. If we go back to late 2025, silver was hovering in a range that felt safe. Then, the calendar turned to 2026, and the fuse was lit. Let's use the Sprott Physical Silver Trust, PSLV, as our proxy for the spot price. 6 months ago, we were looking at a base of roughly $20. As of today, we've seen intraday swings touching $38. That is a move of nearly 174% in a window where most traditional assets were flat or retreating. But here is the catch. It has been mooning and crashing simultaneously. We are seeing gap-ups, where the market opens $2 higher than it closed, only to plummet $3 by lunch. This isn't a steady climb. It's a high-velocity battlefield. If you own physical silver, the psychological toll of these 14% intraday moves is immense. It forces a fight-or-flight response. Do you take the win and sell, or do you hold for the life-changing gains? To predict the future, we have to respect the past. Let's look at the blow-off top of 2011. I remember that era vividly. In early 2011, silver went parabolic, moving from roughly $30 to nearly $50 in a straight line. But look at the daily candlesticks from that era. When the momentum broke, it didn't drift lower, it evaporated. It fell from the mid-40s to the 30s in a single week. The 2026 chart shows a similar parabolic curve, but the why is different. This time, it isn't just retail hype, it's geopolitical necessity. With the U.S. and Iran currently locked in a high-stakes conflict, the war premium should be driving silver to the moon. However, as of March 2026, we are seeing a strange war paradox. Usually, war sends precious metals higher, but this month, silver and gold have actually slid over 15% from their January peaks. Why? Because the war has sent oil prices screaming past $100 a barrel, which markets are reading as a massive inflationary shock. Instead of fleeing to silver as a safe haven, big money is rushing into the U.S. dollar and treasury yields, which are hitting 4.2%. Traders are betting that the Fed will have to keep interest rates higher for longer to fight this new wave of energy-driven inflation. So, silver is caught in a vice. The geopolitical chaos wants to push it up, but the resulting strong dollar and high rates are acting like a lead weight. When you see those long-wick red candles on the chart, that is the sound of Wall Street fighting over whether this is a safe haven rally or a high-rate collapse. Let's move past the noise of the paper markets and look at the cold, hard data. While the futures traders in Chicago are selling paper silver out of fear, the physical market is undergoing a structural transformation. As of March 2026, the silver market is entering its 6th consecutive year of a structural supply deficit. The Silver Institute has confirmed a projected shortfall of 67 million ounces for this year alone. But here is the fact that should make every silver investor sit up. Exchange inventories are evaporating. Across the COMEX, the LBMA, and the Shanghai Gold Exchange, total identifiable silver stocks have plummeted by an estimated 27% since the start of the year. In China, the world's largest silver refiner, the government has just tightened export controls, authorizing only 44 companies to ship silver abroad for 2026. This is a massive shift towards supply rigidity. China is signaling that it needs its silver for its own industrial revolution, specifically in AI and solar, leaving the rest of the world to fight over a shrinking pie of available metal. This brings us to the most critical factual shift of 2026, the battle between solar thrifting and AI infrastructure. For years, the solar industry was the undisputed king of silver demand. But in 2026, we're seeing a fascinating change. Because silver prices hit $121 in January, solar manufacturers have gone into overdrive to find alternatives. Major Chinese producers like Longyi and Jinko Solar are now mass-producing silver-free, or copper-back cells. As a result, silver demand from the solar sector is actually projected to drop by about 7% this year. However, and this is a big however, that drop is being completely neutralized by the AI explosion. High-performance AI data centers are roughly 20% more silver-intensive than traditional server farms. From the advanced GPUs to the high-conductivity cooling systems, silver is the backbone of the AI hardware stack. While solar is using less, the AI campuses being built by big tech are consuming it faster than mines can pull it out of the ground. When you combine this with a mining sector that is only growing at a sluggish 1% rate, mostly as a byproduct of lead and zinc mining, you have a recipe for a squeeze that can't be fixed by simply digging a bigger hole. So, where does this leave us? Is $150 silver realistic? My answer: the math says yes, but the timing depends on human psychology. I use what I call the Fred indicator. Fred is your friend, your cousin, or your barber. Someone who has zero interest in macroeconomics. When Fred calls you up to ask how to buy silver because he heard about it on a morning talk show, that is your signal that the top is in. Right now, Fred hasn't called. Most people are still distracted by the volatility in the stock market or the latest crypto swing. Silver remains the quiet monster in the room. We are currently in a healthy correction phase, with the $70 support level holding firm for the third time this year. This consolidation is necessary to shake out the speculative froth from the January peak. Once the market realizes that the U.S. Iran conflict is a long-term inflationary reality and that the physical supply of silver is being hoarded by industrial giants, the next leg up could be vertical. We are living through a period of extreme volatility that will make or break portfolios. Between the war paradox in the Middle East and a physical supply chain that is reaching a breaking point in China, silver is the most misunderstood asset on the planet right now. Watch the physical premiums and watch the vault levels. The truth isn't on the ticker, it's in the inventory.